Today we're diving into something extraordinary happening in Tokyo, something that could shake the foundations of global finance. We're talking about the US dollar on an unprecedented losing streak, Japan's central bank preparing a move that nobody saw coming, and a currency battle that's about to send shockwaves through every market on Earth. And trust me, what I've saved for the end of this episode is going to surprise even those of you who think you've seen it all. I spent years inside one of the biggest media organizations you can name, watching how stories got shaped, how narratives got controlled, how facts were bent to serve agendas. I couldn't stomach it anymore, so I walked away. Now I'm here in Europe, independent, free to speak the truth, and my only job is making sure you understand what's really happening out there. Now, before we go any further, if you find value in this kind of honest, unfiltered analysis, hit that like button, subscribe to the channel, and here's something I want you to really consider. What we do here isn't easy. We spend hours fact-checking, digging through reports, cross-referencing sources to make absolutely sure we're not feeding you fake news or twisted narratives. That takes time, effort, and resources. If you believe in independent journalism that answers to no one but you, please think about sponsoring this channel. It means the world to me, and it keeps this work going. And stick around until the very end, because the most fascinating piece of this puzzle is coming in just a few minutes. For the first time in years, the center of the financial universe isn't Washington, it isn't Beijing, it's Tokyo. Something deeply unusual is unfolding in Japan right now, something that has the potential to reshape currency markets, rattle bond traders, and snap a streak the US dollar has held for half a century. The Japanese yen, after years of brutal decline, is suddenly gaining strength, and the Bank of Japan, arguably the most cautious, the most conservative central bank on the planet, may be on the verge of doing the unthinkable. They might raise interest rates again. Now, I've covered Japan's bond market recently. I've talked about their staggering debt to GDP ratio, but today we're zeroing in on something more immediate, the collision between the US dollar and the yen, and why this matters to everyone watching. To really grasp what's happening, we need to step back to early October. That's when the yen started to nosedive. Why? Because Saita Takaichi won the leadership race for Japan's ruling Liberal Democratic Party. She's a disciple of Shinzo Abe's economic playbook, low interest rates, massive stimulus, an export-driven growth model. Her coalition fractured almost immediately. The centrist party pulled its support. They refused to back her hawkish foreign policy, her conservative social positions. But Takaichi cobbled together enough votes from smaller right-wing factions, and on October 21st, she became prime minister. That's when the chaos truly started. Markets reacted in real time. The yen dropped hard, hitting lows not seen since January. But then, just when everyone thought they understood the script, something unexpected happened. Takaichi's own economic advisor, now the chief economist in Japan, hinted that she might actually tolerate a rate hike. Just one hike, a single 25 basis point increase, maybe sometime before 2027. At first, traders thought it would come in January. But now, the timeline's accelerating fast. There's serious speculation that the Bank of Japan could pull the trigger at their December 18th and 19th meeting, and the yen has already started moving. 2 weeks ago, it touched 157 yen to the dollar, an alarmingly weak position. But then, the momentum flipped. The currency has been climbing sharply, reaching 154 yen to the dollar, gaining more than 2% in less than 48 hours. Now, even at these levels, the yen is nowhere near its historical norm. Typically, it trades around 110 yen to the dollar, but after years of steep, relentless decline, any upward movement carries serious weight. Here's where it gets tricky. Japan is caught in a bind. A weak currency is fantastic for exporters, and exports are the backbone of the Japanese economy. But a weak yen also makes imports crushingly expensive, and Japan imports all of its oil. Every barrel priced in US dollars becomes more painful when the yen is already fragile. This drives domestic inflation higher, and that's a problem Prime Minister Takaichi can't easily solve unless she completely overhauls her fiscal policies, which seems unlikely. But here's the thing, and this is where it starts getting really interesting. After decades of battling deflation, Japan finally achieved sustained inflation above 2% in early 2022. Now it's running around 3%. Inflation has arrived, and the Bank of Japan believes it has no choice but to stabilize prices by hiking rates. That's why Governor Kazuo Ueda is dropping hints. He said the central bank will carefully weigh the pros and cons of raising rates from 0.5% to 0.75%. Markets heard one thing and one thing only. A rate hike is coming, and bond yields shot up. 30-year Japanese government bonds saw their strongest demand since 2019. Yields are now touching highs last seen before the Lehman Brothers collapse in 2007. Think about that for a second. We're talking about levels not reached in nearly 2 decades. And yet, right in the middle of this tightening cycle, Takaichi rolled out a massive stimulus plan worth 2.3 trillion yen, roughly 135 billion US dollars. This is the biggest spending package since the pandemic. It includes cash payments to offset high energy bills, subsidies for households, one-time payments for families with children. Now, you don't need an economics degree to see that this is a very questionable mix. You're combining fiscal stimulus with monetary tightening. It's an attempt to control inflation without crushing households already squeezed by rising prices. But does it make sense? Markets aren't sure what to make of it, and frankly, neither am I. Normally, higher interest rates crush growth stocks because borrowing becomes more expensive. But Japan is experiencing the opposite. Investors are treating a rate hike as a sign of confidence, a signal that the Bank of Japan believes the economy can handle higher borrowing costs. But when you look at Japan's debt to GDP ratio, when you look at the IMF projections I discussed in a recent video, this narrative feels shaky at best. Why would anyone interpret this as confidence? What are they seeing that I'm not? Comment below if you have thoughts on this, because it genuinely puzzles me. Now let's talk about the US dollar, because this is where things get truly wild. Part of this rally in the yen has nothing to do with Japan at all. The US dollar is weakening sharply. The dollar index just logged its 11th consecutive day of decline. That's its longest losing streak since 1971. Let that sink in. 1971. That was the year Nixon ended the gold standard. That's how rare this moment is. That's how significant. With the Federal Reserve expected to cut rates, global capital is already shifting toward currencies and markets that appear more stable, and right now, surprisingly, Japan is starting to look like one of them. Still, the yen is notoriously unpredictable around rate decisions. When the Bank of Japan raised rates for the first time in 17 years last March, the yen actually weakened because the central bank signaled it would move very slowly. And Governor Ueda stayed true to that message. The Bank of Japan has delayed further hikes since January, partly because of global turmoil triggered by President Trump's new tariff policies, and that's where the real risk lies. A rate hike isn't just about controlling inflation. It's about confidence. It's about credibility. If the Bank of Japan raises rates too quickly, Japan could slide back into economic stagnation. If they wait too long, the yen could collapse again, driving energy prices higher and fueling even more inflation. It's an incredibly delicate balancing act, and making the right call in this environment, with so many variables constantly shifting, is almost impossible. As we approach the December 18th and 19th meeting, all eyes are on the Bank of Japan. Not just in Japan, but around the world. Because what they decide isn't just about the yen. It's about Japan's economic trajectory. It's about global bond markets, stock markets, currency markets everywhere. The ripple effects won't stop at Japan's borders. They'll be felt across the entire global economy. Something big is coming out of Tokyo, and when it hits, you're going to feel it no matter where you are. So here's what you need to take away from all of this. Japan is on the edge of a critical decision that could reshape global finance. The yen is strengthening after years of decline, the US dollar is on an unprecedented losing streak, and the Bank of Japan might raise rates in a matter of days. This is a collision of forces we haven't seen in decades, and the consequences are going to reach far beyond Tokyo. If this kind of analysis helps you stay ahead of the curve, please hit that like button, subscribe, and if you believe in independent journalism that digs deep and fact-checks rigorously, consider sponsoring this channel. Your support keeps this work alive. Thanks for watching, and I'll see you in the next one. Before we wrap up, I need to speak to you directly, person to person. What we discussed today, the shifting tides of the global economy, is complex, and getting it right matters. The mainstream machine often churns out content on autopilot, glossing over the contradictions or simply reading press releases. We chose a different path, but I have to be honest with you, the hard path is expensive and it is exhausting. It takes hours of grueling research to verify these numbers, to cross-reference central bank data, and to fact-check every single claim so that we never ever feed you fake news. We don't have a corporate safety net or a boardroom telling us what is safe to say. We only have you. If you value this kind of unfiltered, rigorous analysis, please hit that like button and subscribe. It helps more than you know. But if you can, I am asking you to warmly consider sponsoring this channel. Your support isn't just a donation. It is the fuel that keeps this operation running and keeps it honest. It allows us to dig deeper when others look away. Thank you for trusting us with your time. I appreciate you, and I will see you back here tomorrow.